a good friend once told me, he's like, skeptics sound smarter, optimists live in bigger houses.
What's going on, everybody? Welcome back to another episode of Curiosity Class. Today, I have an extra special guest, Freddy Brick. He's a partner at Muddy Waters, and we're going to be learning all about short selling, research, finance. What are we talking about today?
All of the above. Might throw in a little bit of mining as well, just to keep it exciting.
Crypto or real
Real,
like cobalt,
old
lithium?
school stuff in the ground that you gotta dig up and take out and refine and transport. The boring stuff.
Okay, literally, and you got a board to get
Yeah.
it. So Freddy, give people a background. Like, how did you get into what you're in now?
Yeah. So I think for me it was like a confluence of things. I wasn't one of these 13-year-olds sat around reading about Warren Buffett and like discounted cash flows and all that stuff. Yeah, my dad was in business. I was like generally interested in like business. Like that was discussed at the dinner table. To be honest, wasn't even sure I knew what like an investment banker was when I was like 18. So yeah, it's funny. I speak at like some universities and I sometimes refer to the undergraduates as like the investment banking vampires because, like, the investment banker comes in or finance person, like sucking the blood out of the guy and be like, get all the knowledge. And I'm like, it's so that wasn't me. I was interested in like having a nice lifestyle, but I was kind of like broadly, interested in like stock market from the perspective of like companies and what made them go up and down, but yeah, certainly didn't have like any fancies of being like Ken Moelis or like Steve Schwartzman or something. And so I kind of did like a whole bunch of different work experience in different places and ended up one summer working an asset manager before I went to university. And I was like, oh, this is like pretty cool. These guys like read a newspaper all day and like they're kind of interested in like the way things are working and politics and like a kind of confluence of things that I was actually interested in. And like they also like drove nice cars, and so I was like, okay, this kind of seems like it could be a good place to spend time. I think so that kind of like got me sort of somewhat more interested formally in finance as a potential career. Um, and then I think, really what ended up pushing me into short selling, ironically, was like the financial crisis. So, at the same time as I was starting at university and really learning like finance theory and the kind of very basic building blocks and accounting, the financial crisis was unraveling. And so I saw this confluence of like, hey, there's this kind of like small group of like outsider type guys who made, what I refer to as like fuck you money betting against like the financial system, which was then kind of glorified in Michael Lewis's book, Big Short, and there are a whole bunch of other like excellent books on the topic. And at the same time as so I was kind of seeing that I'm like, wow, these guys structured this like truly asymmetric, interesting trade, um, and it was like highly lucrative as well. And so I thought like that was kind of interesting, and so that's one thing that I think probably, even till this day has like framed the way that I look at risk and think about trade structuring and downside. And then the first job I got was at a fund in Hong Kong, and they were very active in shorting like a wave of Chinese frauds. And kind of like, the pioneering, like cutting edge of like what I now do, which is activist short selling. And so again, I had this like second data point of like, you know, taking concentrated risk positions, really getting in, doing the work and seeing that like pay off really well. And so like, I think those two kind of reinforcing points were like, wow, this is like an excellent way to spend your time and career. Yeah, who knows? Had I been born like 3 years later and my first taste of financial markets would have been 2011. Like I probably would have been like an idiot venture capitalist, much wealthier with like the FBI never turning up at my door. But I joke there are some smart venture capitalists, but I gotta tell you, there's a lot of people that are in venture capital that really don't seem to understand anything about business. But as I've learned over the years from some pretty sharp venture capitalists, like you're not necessarily betting on like the person who has the best business model. You might be betting on the person who's able to raise the most capital to kind of backfill, reduce their cost of capital, and then like we'll find out in 15 years' time if they had a good business model. So yeah, a lot of those people have less stressful days than me, I think. I think about that long and hard. So yeah.
Dude, that's insane. So how did you go? So you were at the fund in Hong Kong, and then how did you how did you get to the States?
So I knew a couple of guys at Muddy Waters. I was doing a little bit of like fraud based short selling in Asia. And so ultimately when I left that fund, one of the guys who used to work here had reached out, and at the time Muddy Waters were based in San Francisco, and so I flew out. I mean, you're coming from Hong Kong, which it was a phenomenal place to live back in 2011, 2012 was, China was like booming. Europe was still really depressed. The US was kind of like sluggishly coming out of, borderline economic depression, if not like a real recession. And so like Asia was just fucking booming. And so it was like a really cool place to be. Like there was a lot of pollution, like climate's kind of like, yeah, it's pretty hot and humid. And you go to San Francisco, it's like blue skies. It's like, like loads of nice looking women everywhere, and you're like, oh, this is fucking awesome. There wasn't like too much of a stretch to get me to go to SF, and yeah, despite like how poorly that city is run, which probably anyone who's sitting in Austin who used to live and work there knows. It was a nice place to live. It definitely wasn't as dystopian and like it wasn't as bad as it got to in the pandemic in like 2014. It was actually a pretty nice place to live. So yeah, that's how I ended up there, and then we moved the business to Austin in the middle of the pandemic. And yeah, we've really enjoyed being in Austin too. Actually, it's been a great place to live.
And you've mentioned a couple times fraud-based short selling. Can you break down, like, for me who's super naive on the entire subject, how do I think about short selling in general? And then is fraud-based a specific subset of short selling?
So most short selling breaks down into a couple of categories, and we'll just park fraud for a second. Most short selling is either to hedge long exposure. So it could be, hey, I run a fund. For every dollar invested, I have a mandate that only 50 cents can be long the market. So I might buy $10 of 10 different companies, and then I'll short $50 of the S&P. So that just gets me to like a target exposure that investors want. Um,
And when you
yeah.
say long,
So owning a
that
stock. So if
means
you own a stock, you're long the stock. If you're betting against it, you're short the stock. So again, investor gives me $100. I tell them, look, for every $100, I'll be directionally, buying the market for 50 cents. And the way I reduce the exposure is I short. And so a lot of short selling is index based, or it's what they call relative value. So you might be long the bond, short the equity in some ratio because you're expressing a difference in pricing between two instruments. Or to be a little bit more esoteric and complex, you might be long one part of a bond and short, a different maturity because you think something happens within a certain time frame. But at a very high level, a lot of short selling like is really just for positioning and to manage people's exposure. Then within that, you have kind of one level deeper, which is like fundamental short selling, which is basically I am betting against a company. Most of it is kind of melting ice cubes, where you say, okay, mall operators, those businesses suck. All right. You've got this real estate 25 minutes outside Austin. No one wants to go to this thing anymore. Like, if I want to go to, I've got Amazon, or I can buy everything from every store I want online. It comes straight to my house. So no one wants to go to malls anymore. And this is a B grade mall. This isn't even like an A grade mall where it's a nice day to like hang out with the family, get out of the house. So like, I think this business has problems. So what you do is you get stock, you go to a bank, and a bank will lend you stock, and the price that they will lend you the stock at is based on supply and demand. So if it's a stock that's in really high demand, the fee I will pay to borrow the stock is higher. And if it's a stock that no one else wants to short, or there's lots of supply, even if other people want to short, the fee I will pay is lower. And then I go into the market and I short the stock at say 10. Well, if I'm right and it turns out at $10,
At 10,
I
10 is the
sell it
price
at,
you.
okay?
Okay.
If I sell the stock at 10, I get
Okay.
$10, I stick that in my bank account. Company has earnings in 2 months' time. If the company's numbers are worse than people think, so people think, okay, they're going to have 20 tenants and the tenants are each going to do a certain amount of sales per square foot. And it turns out that like actually 6 tenants paid to get out the leases because the foot traffic in the mall is so much worse than people expected. And maybe we had a really hot summer and the guys that were left in the mall were only selling overcoats. And so, like, their numbers were really bad. So they can afford to pay less and less rent. The stock will decline. So maybe the stock declines to 8. So what happens is you go back into the market and you buy the stock at 8. And so you sold the stock at 10. You pocket $10. You go back into the market. You buy the stock at 8. So your cash flow out is 8. You keep the difference between the two. And so I don't know the exact number, probably 80, 90% of people who are looking to short companies are looking to short things like that. Boring businesses, fads, things that are like over earning, like Peloton, right? So Peloton got to like a 30 billion market cap. It wasn't a fraud. They weren't doing anything wrong. It was just once everyone sat inside and bought a Peloton, which was really just an iPad attached to a bike, people extrapolate, oh my God, they're going to buy like more and more. And then it's going to, everyone in Africa is going to have a Peloton, and everyone in Asia is going to have a Peloton, and they're going to be able to sell them like a yoga subscription, and no one's ever going to cancel. We'll tell you what, turns out that if like you go outside after the pandemic, no one wants to use the Peloton, and mine, like everyone else's, is just something I hang clothes on. So that's kind of a classic example of where people get overhyped, they get excited. The management team aren't doing anything wrong. Like maybe on the margins, they're doing like little bits and pieces to make the business look better. But generally speaking, it's just a product cycle. It's a fad. And so a lot of short selling is really trying to be forward looking and take a view on the next quarter, the next year, the product lineup, whether they're going to be successful. Fraud and accounting short selling is really a bit of a subsect of that. I would say accounting based short selling is probably a larger subsect. Fraud based short selling is really like a very, very small niche subsect. And then within that, what we do where we're activist about it, where we publicize our views, is even smaller. So you would think that shorting frauds is great. You would think that's like the best return because like it's a fraud, right? Like the stock should be worth zero or very close to zero. If you had unlimited time and an unlimited risk budget, yeah, I mean, in theory, like shorting frauds is pretty good. The problem is you can short a fraud down here at $10. The stock can go to 100 because no one else knows it's a fraud, and the management team are very charismatic, and it looks like things are going really, really well. And then it can go all the way up from 100 all the way back down to zero. And the problem is, if you had a 1% position at $10 and it went all the way up to 100, it's now a 9-10% position, and you might be out of business by then. So the issue is risk managing frauds is extremely difficult relative to kind of the way most people do the kind of melting ice cube short selling. And so our approach is when we find companies that are fraud, and fraud is like an amount of what we do. A lot of what we end up doing is kind of what I would call legal fraud. And I can get into that in a bit more detail. But like outright frauds, there isn't the factory, the product, like, actually kills people, off balance sheet debt that they haven't explained, things like that. Um, that kind of fraud is, if you don't go out there and expose it, it can go on for a very, very long time. Probably one of the best known cases is a company called Wirecard. people started shorting that in probably 2007, 2008. It got up to like a 20, 30 billion euro market cap. The German chancellor was defending it. Deutsche Bank nearly bought the business. SoftBank invested, and ultimately it was a total zero. None of the cash was ever there. There's an excellent FT series on the former, I think it was the CEO, I think it was the COO, Jan Marsalek, who it turns out was a Russian GRU intelligence officer. Like crazy, crazy story. They had like Syrian intelligence follow people around in London. Like, I have a friend whose house was broken into and his laptop was stolen. Like, our computers were hacked. Crazy shit. The FT did a podcast. If you like Google FT, I want to say it was like Agent of Chaos is maybe the podcast written by I can't remember the name of the journalist, but really really good, on a guy called Jan Marsalek. Like, that is like how insane fraud based short selling gets.
Dude, how do you, what does your day look like? Like, what do you do? Because you were just like, where do you start?
So yeah, my day starts early. Just because I have a nearly 2-year-old who likes to wake up at 5:30. They call it like a sleep regression, but like it's torturous. I know people who probably got like 6 kids being like, "Ah, suck it up." But no. So like for us, we don't do tons of screening. A lot of what we're looking for are bad people, low quality auditors, funky kind of business descriptions. So we don't do tons of like just pure accounting based screening. Um, my kind of typical day is I get into the office around 7:45, review the P&L. We have, three or so. We have two funds that really do short selling. So you look at the P&L, just check where things are relative to hedges and like where the total exposure of the book is. Make any decisions around things you're going to put on or trim or those kind of things. So we kind of look at that. Market opens, and then for the most part, it's actually like pretty quiet. Like, we're not sitting around screaming buy sell. Like, on one monitor, I've got like some stuff we're looking at. Like, we've usually got 2, 3 projects at any time that are kind of in the middle of the funnel. So sometimes we have funds that will come to us and they'll say, "Hey, I look," it could be anywhere as detailed as like, "Hey, I have this like 10-page deck. I'm already short the stock. I'd love you guys to take a look at this and see if it's something you want to publicize."
But in that case, like, they're incentivized because you said they already had a short position.
Yeah, their hope is that we go out, we have quite a well-known brand, and we talk about this, and like that catalyzes the move. But it could be something as innocuous as, "Oh, hey, Freddie, I was at this conference. I asked the CFO a question. He just like didn't really answer it. I followed up with him twice. It should be a very bog standard question for him to answer. I can't really understand why like he was so evasive, or like his answer totally doesn't make sense. Or maybe I'm looking at a cool transcript for a company that seems to be doing much better than everyone else in a highly commoditized industry, and you sort of notice like, hey, the analysts keep asking the same question and they always obfuscate the answer, and they're always changing the narrative. Like, one time they're talking about, oh, it's all about revenue growth, then it's all about EBITDA growth, then it's about free cash flow, and then like, they keep jumping around and nothing ever stays the same. And so, for us, that's kind of what we're often looking for, just like things that are a little bit outlier. The other thing we end up finding is we often end up being a little bit thematic, because if you have something like genuinely good, so let's take, for example, Tesla, okay? Like, controversial stock, but like he's been successful. How he's got there, like we can argue about, but like, it's a 1.6, 1.8 trillion cap, whatever. Um, so you have like the first mover, Tesla, and then you have companies 2, 3, and 4 that IPO that are kind of EVs. So maybe it's Rivian, maybe it's someone that GM have a partnership with. They're kind of real, right? They're probably like real people with real venture backers. Whether they're going to be successful or not, I don't know. But then you have the grifters, okay? Then you have the people like, hey, just had like $28 billion of capital raised in IPOs. Wow, like, we've kinda got something that looks like that. I mean, it's shitty, it's a hybrid, it's not an EV, doesn't really work, but you know what? Investors are excited, they're looking for the next winner in that space. If we kinda take this, we just pretty things up around the margins, and we take it public, it could work. And like, we might be able to get a $5 billion market cap and sell a bunch of stocks. So we often find ourselves, people 5 through 25 that are IPOing in an industry. That's usually an area for us. We're like, okay, that could be interesting. Like, there's a lot of capital, a lot of people are rushing through the door there. Like, that might be an area where, like, there's the kind of people we like to follow, um, because the chances are that those people are really just like attracted to the capital, and the people who have maybe gone and raised like, oh, like, well, I was a really successful Tesla investor, I'm going to go and raise a dedicated fund to invest in EV companies. Well, if there's only 5 good ones and you've raised $1 billion, you might say, okay, I'll put some money in the rest of these things, like whatever. And so that's often kind of what you see happening, where there's this kind of symbiotic relationship between the people who raise capital, the people who want to put product to work, and that's not necessarily great alignment for investors medium to long term.
Sure. And maybe this is a silly question, but when you're shorting, like in your day to day, when you're shorting a stock, does it have to be publicly traded or can you short a private company?
You can't really short private companies. People have tried it over the years. Like, there's private companies that issue debt or loans. Like, sometimes people have done that. But generally speaking, it's been a very, yeah, like, people have looked at it, but the problem is you have information asymmetry on the guys on the long side in the private company know more about the company, generally speaking. So you have information asymmetry. Then, like, what's the mechanism of like accountability on like posting margin? So it's kind of tricky both ways.
And so again, maybe it's a silly question, but like when you're looking at, like you said, companies 5 through 25 who are pre IPO, I know you said you don't do a ton of like accounting auditing, but like surely you're looking at some numbers. Like what are you looking at to see their numbers?
Yeah, you are. So, an example of that, there was a company called XL Fleet Corp. Um, it went public via SPAC in 2021. Can't remember off the top of my head.
Just to pause for a second. So there's SPAC, there's IPO, and just can you explain the difference between the two?
Yeah, so SPAC is a company where you have a sponsor. So you have like a deal person, like typically an ex banker or something, and they say, "Look, I've raised 200 million bucks, and I'm going to go and buy a private company, and you're going to pay me for the privilege of doing that, and you're paying for my like deal underwriting and quality due diligence and my deal flow." It's honestly like the most one-way sided bet in like the history of finance. It's fucking insane. Um,
Like why do people do that as opposed? And I honestly don't. I couldn't tell you what like IPO initial public offering, but I don't know what that is.
so generally speaking, the pitch to companies is like, look, it's faster, right? You don't have to go through this like long process. We're not going to underprice your stock. A bank will underprice your stock so that clients can make money on the IPO pop. Like, we don't have an incentive to do that. That's total bullshit. There's lots of perverse incentives with SPACs. And the idea is, yeah, it's just a faster route to access the public markets with honestly less scrutiny. Look, an IPO is like a longer process. And then you have this kind of like, do I, don't I get to IPO? Like, if the market cracks while you're trying to market your IPO, that can be tough as well.
But this is what I'm confused about because you said like it went public via SPAC. So in my mind, I understand that to mean once it goes public, it's public. It can be listed on any exchange. So what's the down like if you do want doesn't it make sense to get to the market faster, like to go public faster?
It does. But you dilute because you pay the promoter effectively. Um, Generally speaking, like, if you have a great company, why can't you just go to a bank, get investors excited, and take the thing public? Why do you need like the stamp of some SPAC sponsor to be like, oh, I diligence this, this is great, and for the privilege, you end up with 10-20% of the company, like, as your kind of upside equity. So there's a lot of downsides to SPACs. They're great enrichment vehicles for the people who run them. Genuinely.
Okay, all right. So going back to XL Fleet Corp. So it went public via SPAC.
Yeah, so that was a company, for example, that, they had these like we looked at what they actually had, and it was like this crappy hybrid truck thing. And they had this pipeline of sales. They were like, oh, they did like maybe 12 million of sales in 2020. They were like, oh, we're gonna do like 24 million sales. And they're saying like, yeah, by 2025, we're gonna do like 3 billion of sales. Like I can't remember the exact numbers, but it was some like insane ramp. And we've got this. They had a slide deck with their the sales projections, and we spoke to a former, and we were like, who's buying this crap? Like, I mean, these things are literally like the technology was likely no better than like your Prius. Like genuinely, that was like the level of technology. It was like the brake restorative. It takes energy from the brake. So if you're like UPS and you're stopping every 3 seconds, in theory, you can make some energy savings. Um and so we spoke to him, and I was like, well, how, so I spoke to a former sales guy, and he was like, well, yeah, the backlog, like, it was more art than science. I'm like, what do you mean? He's like, so I'd speak to Coca-Cola, and I'd be like, hey, how big's your global fleet? And they'd be like, like 9,000 vehicles. He's like, okay, well, like, I don't know, would you trial this? And they're like, yeah. And he's like, cool. I mean, what, if you think about it, like, what percent of your fleet could, like, maybe eventually use these vehicles? And this was at the time where everyone was like greenwashing. So like, it was like, we gotta like, show all these partnerships with these green companies and hybrid. So he's like, yeah, I mean, yeah, like, is it fair to say that maybe 5% of your fleet could be using our vehicles in 5 years' time? Yeah, yeah, sure. Okay, cool. Five times, 30. That. Okay, cool. Put that down as like a, $150 million like pipeline order. That's basically like what they were doing. And so again, it's not a tight metric that like that's not a metric the SEC like there's no defined thing for pipeline, right? So it's this like squishy area of like these guys actually ended up paying like I think a decent sized fine because like probably they found some emails being like, yeah, hey man, like juice those numbers up. So like clearly I think there was some like very thoughtful wrongdoing there. But that's not a metric. Like there's no such thing as like pipeline or like order backlog. These are not like established accounting metrics. So if you're just making aggressive projections, and unless you're stupid enough to like literally email your boss being like, hey man, I'm totally making these projections up, but like we can juice these for the deck so investors buy the stock, which very few people are stupid enough to actually do that. Um, it becomes this like subjective, hey, like, I don't know, we spoke to Coca-Cola and just turns out they weren't as enthusiastic after the fact, like, oopsie. We sold loads of stock, like investors got absolutely fucking hosed. Oh well, rinse and repeat. So that's kind of the stuff that we find is like pretty prevalent in some of these companies.
Dude, that's wild. Have you always do you think that you've always had this like BS detector, or has that been honed over your career? Because I feel like at the end of the day, like you're looking for things that are not real, right? Like, is that fair?
Yeah, it's a good question. I think like look, to a certain extent, like you have to have a natural degree of skepticism to do this. You can't see fraud everywhere. And then there's a balance between like, okay, these guys are just like marginally pushing the envelope, and this appears to be like really profoundly problematic. So it's like a fine line that you got to calibrate and work out like what will people care about, what's kind of just generally understood to be like traders' path. I mean, look, Elon was like the master of this, right? Like he did things that I think were well over the line, and he just pushed the line further and further and got investors to not care. And it reduced his cost of capital. And some people think he was playing this very long game. Some people think he was just doing whatever he had to do to get to the next stage, and like, you know, sort of kind of lax regulator and said like, hey, the chance of getting caught or the fine I'm going to pay is irrelevant. Um,
What's an example of that? What do you mean?
um, so I think, if you look at like the board minutes from when he took solar, was it Solar City, the kind of rooftop solar thing he had. I mean, he's done like fake demos with stuff from time to time, whether it's like the robo taxis or the solar roofs or any of these things, and he's like outright faked demos, and people are just like, whatever. He was kind of demoing; it didn't really matter. And so he's kind of created enough room for himself that people sort of expect it, in a way that more buttoned up companies wouldn't get the latitude to do it.
Right, right. Dude, it's so funny. As you were saying, like the robotaxi thing, in my head, I was thinking, oh, well, everyone kind of knew it was fake, but like it's okay because they knew it would be real at some point. And I was like, oh yeah, like that's that's not a thing for other people.
Right. To be like, I mean, that's, if I do that, that's like fraud. But yeah.
Right, right, right. That's super interesting. That's super interesting. Can you share like, and it's totally fine if you can't, but like the biggest bet you've ever made and like how it worked out?
Yeah. I mean, it's funny, like the names we've put the most amount of money to work into haven't actually always ended up being like the best P&L scores. The ones that have like ended up from like just a remuneration perspective being the best have sometimes been like the smaller ones that move a lot more. Um, I don't know, probably like the biggest swing we ever took at something was a Japanese company called Nidec. Very liquid Japanese company. They make hard disk drive motors, and then they had like another part of the business where they do other kind of electric motors. What's crazy about that is like no one cared at the time. We published a report, explained why Nagamori, the CEO, was like totally full of shit. How like there was this narrative like, oh, he was brilliant at M&A. He was going around doing like acquisitions every couple of months, and we went and we looked at all these acquisitions, and people were like, nah, he never came here. Like they never improved anything. The operating margins never improved. And 10 years later, literally just the other month, about a year and a half ago, they started admitting they had some major accounting problems, all driven by this highly aggressive culture of his. Um, Literally like 10 years later, people cared. Like we were like 10 years too early. And it's literally everything we said, like channel stuffing, very aggressive, like inventory accounting, revenue pull forward on stuff, subsidiaries that had to meet like certain thresholds that they couldn't. And so yeah, sometimes you're right and the market just does not care. And a lot of that is to do with how CEOs are like generally very charismatic, and oftentimes it's about narratives. And if you can't break the narrative and get people to really like focus on the numbers or what's going on, there's a pretty good chance these guys get away with it.
Is the process for your firm like you will do you have your because you're investing money as well, but you're also publishing this research, right?
Yeah, so model for us is we take positions out of the research, like it's all fully disclosed. It's not like big secret. We take positions out of the research, and then we publish the research. And the idea is like, you catalyze the stock to reprice. And that's how effectively, you make the money to pay for the ability to go and do the research. So, like in many senses, I mean, it kind of straddles between like investigative journalism and like a more traditional hedge fund model.
Sure. Sure. Do you and this is gonna be a broad question, but, like, how do you think about for you personally, like, how do you think about learning? Because you were just describing
Yeah.
things, and I was just thinking, like, man, you must be seeing so many different kinds of companies doing so many different kinds of things, and, like, I'm sure you have this general accounting framework, but, like, I is that how do you think about all this stuff?
Yeah. So I think one of the biggest um, sort of mistakes that people make in investing, or especially in like short activism, is like there's a lot of known unknowns and then there's unknown unknowns. So, you when we look at new industries or even industries that we know reasonably well, like we bring in specialists, we speak to former employees, we speak to experts in like even within like accounting, like certain minutiae where accounting standards have changed. We bring people in to help us understand these things better. So a lot of it is like learning through people. Look, you can get like awesome papers on stuff. I certainly wouldn't rely on like research from investment banks. That stuff is complete fucking garbage. But there are like often good industry pieces and kind of teach-ins where they have slightly less of an incentive to just try and like force a stock idea down your throat. Those pieces can be better. Yeah, I mean, I think like industry conferences are an awesome way to learn. Like, you ideally want to get out of a place where someone's trying to sell you something if you're trying to learn about it, because ultimately you want to get into like an environment where people can tell you, and they don't have like a particular bias to telling you one thing or the other. So yeah, we find industry conferences can be a super useful place to kind of really learn about things. Um, and then yeah, I mean, books, Twitter's got some like really interesting stock ideas and people who are like subject matter experts and things. So yeah, like we try and suck in a pretty broad pretty broad like base of places we're pulling in from.
Okay. And what percentage of your time is spent learning new things versus analyzing like existing, like underwriting, so to speak?
Yeah. Less time learning new things than I like. I mean, I'm definitely spending a lot more time thinking about how we can incorporate AI into the business recently. I mean, up until last year, I just thought it was a bubble and a complete waste of time and garbage, and I've like completely changed my view on that. Um, just having used some of these products now over the last 4 or 5 months, I really do think this is like transformative for workflows. Like, quite how, I'm not entirely sure yet, but like I can certainly see like lots of use cases. So I think at the moment that's where I've really been focusing my time on learning and just I'm trying to suck in as much as possible. And it doesn't help that obviously things are changing pretty fast there. So, but I think like the core building blocks, like trying to get up the to speed on that is probably time well spent.
So what are those 4 to 5 products that you've been using, or things that you're looking at with AI?
Yeah, so mostly using the Anthropic products, using Claude a lot. Yeah, I've used Gemini a bit. I think that's pretty good too. I think sometimes it's nice being able to like switch between the two just to try and like, it has a bias to telling you what you want, or it has a bias to kind of sounding helpful. And so being able to like take what you want and put it into something else, or like say, hey, like I'm taking this out of a conversation now, putting this into another conversation, find all the faults with this, or look at this from the perspective as a risk manager, or look at this from the perspective of a journalist or something, and trying to engage with it like that. The Excel plugin for Claude is awesome. I'm actually just trying to get co-work as well installed. So yeah, just taking like an open view that like, hey, a bunch of this stuff's really cool. I want to kind of fiddle around with as many different things before we like sit down internally and really kind of work out what we're going to try and build on. Um, so yeah.
And I mean, you kind of just mentioned it, but it sounds like AI is something you've changed your mind about pretty recently. Is there anything else you've changed your mind about recently that you can think of?
Anything else that changed my mind?
Still not into cold plunging?
Still not into cold plunging. I'm not sure there's like any science behind that stuff. I mean, like, I don't know. It's kind of look on that. Like, it's funny. There's this like study in the UK of like people who live near Hampstead Heath and go and do like this. Yeah, they do these cold water swims. Like, they live longer. I'm like, yeah, because all the houses around there are like 6 million pounds, and so like, and anyone who can be bothered to get up at like 6 in the morning to go and like do some exercise, like who's in that bracket of wealth, like guess what? Lo and behold, they live longer. What a shock. So I don't know. It's funny. I think there's like a lot of people who buy cigarette lighters die younger. It's, is what it is, right? There's a cause and effect there. Yeah, I think like honestly, I think for the most part, really have like massively changed my view on AI. Like November, December last year, I just thought it was like I hadn't used a lot of the products for a while. I'm not actually that I wouldn't say I'm like the earliest adopter on tech, and I don't spend time like, oh, this model is coming out that, and then I randomly used Claude for something in January and was like, wow, this is really like a step change function forward in terms of like the output I'm getting. Certainly not perfect, but to get from like 0 to 50, 60, 70 on something, it's really fast. And I think the implications for the way we work and for young people entering the labor force, and kind of like the my sense is for like mid-tier plodding along like the bottom 10% of most white collar workforces, like I think the implications are pretty profound.
You mentioned you had a 2-year-old. So how do you think about their future in like just a world of AI? Like, do you think about like what it'll look like in 18 years or 16 years?
Yeah, it's honestly, it's like a little fucking grim, to be honest.
Really?
Yeah, well, I think the kind of transition between where we are now and where we end up in a couple of years' time is potentially quite painful. Look, I think the back end of it could be pretty cool. Like I went to a meetup, like a beginner AI meetup thing last night, and there was this dude there who, he's one guy and he's been into AI for like 3 or 4 years. Like I honestly don't know how good he is with the stuff, but he was showing some like cool basic things he built. And he was just like, look, I'm one man. And he's like, I've been able to apply for this grant that took me like 3 weeks from Europe, which would have taken me like, he's like, I asked other people, like, oh, it takes like 6 to 8 months. I can do marketing, I can chop up video, he's like, I can do all this myself. He's like, okay, maybe it's not the best, maybe it's not like making me the salesman of the year or like, maybe like my grant application is like pretty good, but he's like, all right, but it didn't take me 6 months and like I don't know how to do this and I can get like pretty basically good at like most of these things. And so I look at like a lot of young people who I think would have probably gone into these like more corporate roles. And I think the ability for them, if they've got a good idea to iterate and test it, if they're like hungry and they want to do things. And yeah, I think like the ability for young people to kind of like really accelerate and have these kind of like mini little businesses that like instead of needing 5 people, you have one or two. And I think the moat for a lot of these kind of smaller to like mid-size incumbents is getting eroded like pretty quick. So yeah, I think like that's actually pretty cool and exciting and could really change things. But I think like the pain point between then and now could be, yeah, it could be a little tough for people.
Totally. Yeah, that's fair enough. That's fair enough. Well, when you think about yourself, do you consider yourself a pessimist or an optimist writ large in general?
That's funny. A good friend once told me, he's like, skeptics sound smarter, optimists live in bigger houses. I I guess I skew pretty neutral, honestly. I look, am I optimistic and like my ability to like, produce decent investment returns and continue to find interesting ways to make a buck? Sure. Am I, do I often like look at how the sausage is made and see a lot of risk where other people are like, it doesn't matter. Like, that scenario, you play it out like 10 times and 9 times you're fine. And I'm like really focused on the 10% of the time it's not fine. Like, yeah, does that make me a pessimist? Does that make me like just pretty attuned to like risk and like capital impairment? I don't know. You could argue that both ways. Yeah, like look, I think humans like to either kick the can down the road or like find quite creative solutions to stuff. So I certainly don't sit around expecting the world to end anytime soon. It's only gonna end once.
No. Well, Freddie, I appreciate you, man. Thank you for coming on. Thank you for doing this. If people want to learn more about short selling or this type of stuff, like are there resources you recommend?
It's like the worst thing to learn more about. Like the worst thing you can ever do is learn about short selling, find something that's a fraud, short it, and think that's a good way to make money. I think there's some really good books out there. I think like, you can read any of the literature around the financial crisis. One book I want to plug if you ever get a bit more advanced. My friend Rory Boyd wrote it, Fatal Risk. It's about AIG. It's a really under the radar book. It's brilliant. It's probably the best book on the financial crisis. So yeah, Fatal Risk by Roddy Boyd. If you ever get like really advanced, but there's tons of good literature out there on short selling. So if you're interested, check it out.
What would be the book to prepare to read that book? Like what would give you good fundamentals to read the advanced one?
Okay, so I think if you want to take it's a good question. Greatest Trade Ever, Greg Zuckman. That was pretty good about John Paulson's subprime trade. The Big Short's very good. Um, the Andrew Ross Sorkin book, name eludes me. That was pretty good.
Not his new one, not 1928, the other one.
No, I thought that had some like interesting perspectives. 1929, but I don't know. I like towards the end, I was a bit like. I was expecting like a little bit more in the weeds, and like it was really good on the characters and stuff. But yeah, it'll come back to me. It was like one of the seminal books on the financial crisis. But yeah, any of those be good prep.
Okay. Awesome. Well, Freddie, thank you again, man. I appreciate you. This has been so interesting.
Yeah, great being on, man. Really appreciate it.
Thank you. All right. Bye, everybody.